Should you invest in Bharat Bond ETF? Hi, I'm Rin Agarwal. I'm a financial educator, and in this video, I'm going to be decoding the Bharat Bond ETF new issue, which is there from July 17th to July 20th, 2020 for you. This is the second tranche of the Bharat Bond ETF. There are basically two series in this ETF. There is a series which matures in 5 years, and there is a series which matures in 11 years. Essentially, this ETF invests in bonds and they follow the Nifty Bharat Bond indices, which basically has AAA rated PSU bonds. Now, there is no dividend that's available in this particular investment. It's basically a cumulative investment. Since it is an ETF, you can of course buy and sell it on the exchange. The product is also available as a fund of funds. So if you don't have a demat account and you want to invest directly with the fund house, then you can apply for the fund of funds. The expense ratio charged on this product is very low. It is 0.0005%. And if we were to look at the previous performance of the Bharat Bond ETF, well, it's done really well, but that's also because interest rates have come off by more than 0.5% over the last 6 months. So should you invest in this particular scheme? Let me talk about the positives first. Firstly, the fund only invests in PSU bonds, and hence to some extent they are very safe because of the sovereign guarantee that's available. It is very liquid because, as I said, you can buy and sell it on the exchange. If you were to hold it to maturity, you can be pretty sure about the return that you're going to get on this investment. It follows debt taxation. So after 3 years, it's going to be taxed at 20% plus indexation. So if you really compare it to other products that are available, let's say on the 10-year time frame, you would find that most of the other products are actually fully taxable, whereas over here you are having debt taxation. What doesn't work for the product, given the current yields which are at around 6.54%, we are looking at a post-tax return of 6.21%. Now that's a pretty low return for a 10-year period, and you need to be very clear that if you are investing in this product, you are doing it because you want to lock your money into a fixed return instrument where you don't want any volatility at all. Secondly, there is absolutely no interest that is payable on this particular product. So, of course, if you need money from the product, you'll have to go and redeem those many number of units. Thirdly, ETFs don't have very high liquidity at this point in time, and that is a little bit of a downside as far as ETFs are concerned. And finally, if you are looking at investing into this for the short term, it's absolutely a bad time because the 10-year yields are at the lowest at this point in time. And there would be interest rate risk on this product because if the yields go up, the NAVs will certainly fall. So be very clear that you want to lock in money for 11 years. You're okay with the low yield at 6.21%. Think about it. I mean, if you can actually extend your period by 4 years, you could actually even put money into a PPF investment as well, which is certainly giving you a higher return. It's still at 7.1% right now. My take, invest into this if you're absolutely clear that you can hold on this investment for 5 years or 11 years as the case might be. The overall post-tax returns don't look that great, and hence your reason for investing here is because you are a conservative investor and you really don't want any volatility in your debt portfolio, but you're okay with these low yields that the product gives.